The goal of income investing is to ensure that your portfolio generates a steady source of revenue, regardless of market conditions. Investment income can come from many sources, from bond coupons and equity dividends to other investments such as mutual funds, exchange-traded funds, and investment trusts. Without income, investors would have to regularly sell assets to realize capital gains, whereas income-producing assets allow investors to generate a cash return over longer holding periods. Income can also help to preserve overall returns during periods of volatility, since the income keeps coming even if a portfolio's assets have fallen on a mark-to-market basis. Income options can be limited in equities because only investment-grade, blue-chip firms tend to pay consistently large dividends. Bonds, however, offer investors a full spectrum of risk, from investment-grade governments to financials and high-yield corporates, meaning fixed-income investors can build a portfolio calibrated to their desired level of risk and access income from a wider range of industries and regions. Bonds are referred to as fixed income for a reason. Equity dividends can be adjusted according to company performance, whilst bond coupons are fixed contractual payments. Bonds also possess a couple of fundamental features, making them attractive income assets. The first is a fixed maturity date. In addition to income from coupons over the life of the bond, investors receive their initial investment back at maturity. This means there are only two ways an investor can lose money on a bond. Either the bond issuer defaults or the investor chooses to sell the bond at some point before maturity, when the bond is trading below the purchase price. Another low-risk feature of bonds is pull to par. As a bond approaches its maturity date, its cash price will begin to return to its par value, as default risk becomes increasingly negligible. Pull to par occurs whether a bond has risen or fallen in price during the holding period, since the bond repays at par on the maturity date regardless. Over the long term, income will likely be a far bigger driver of returns for a bond portfolio than capital gains, making income a crucial consideration for portfolio managers.